to our 3 global strategies with long checking records. And in 2019, we added a US version of our multi-asset ETF portfolios. Corresponding to global and US multi-asset portfolios, we launched our global and US indices, ranging from conservative 2080 to the most aggressive all-equity index. I'd like to mention here that all our indices are constructed in exactly the same way as our portfolios, following the same investment process Robert just went over. The index's returns are calculated and verified by S&P Dow Jones. And I'm very excited today to show you the spectacular performance of our indices for this quarter and for the year. But before jumping into performance, I'd like to take a brief recap of 2020. We know there have been a lot of going on in the market. Dramatic sell-off in March was followed by a fast recovery throughout the remainder of the year with the Fed support. In Q4, we had US presidential election. We got promising results on the vaccine and expectation for another round of stimulus package. And with more confidence and hope, markets continued their upward momentum in the final quarter, making for a strong close to 2020. So this is what happened behind those numbers. Later, John will give you more detailed version of market overview. Okay, now looking at the table, please note bolded numbers are New Frontier Index performance. All our index performance show the biggest outperformance we've ever seen, and they have closed all-time highs. Let me highlight US index first. They posted fantastic Q4 performance, outperforming the benchmarks up to 400 basis points, which was in particular helped by exposure to small cap value during the Q4 reversal. And moving down to annual performance, US index passed its first full-year test with the best possible grade. US all-equity index gained 550 basis here, more than S&P 500 for the year, and that is phenomenal. And not only US index, but also our global index deserved a moment of cheering. We're extremely proud that we had the best performance ever for global indices across the board. Our global 60/40 and 40/60 index beat the benchmarks by up to 500 basis points for the year. Again, this is beyond amazing. Our 60/40 index outperformed other balanced peers in the market as well. And we know this is not the result of pure good luck. We were not betting on directions or timing the market. This is what we got from following our investment process. As Robert has talked in the investment overview, global 60/40 index with the broadest exposure to fixed income and equities benefited most from our multiple rebalances this year. So move on to our global tech-sensitive portfolios. What we have here in the table is our net of fee portfolio performance for Q4 and for the year. Overall, tech-sensitive have performed in parallel with our global multi-asset portfolios as we have expected. Again, amazing quarter and incredible year. Similarly, 40/60 and 60/40 tech profile benefited from rebalances and posted great performance for the year, outperforming benchmark by 200 to 300 basis points. I'd also like to mention about munis. As an important allocation in tech sensitive, it continued to produce steady returns over the course of recovery. And I will talk more about assets in later slides. Next is our global multi-asset income portfolios presented with net of fee portfolio performance in the table. Multi-asset income is slightly different from our global multi-asset portfolios as it's constructed to provide a sustainable and reliable source of income. In terms of total returns, multi-asset income lagged the dividend-heavy benchmark during Q4 reversal but performed largely in line with benchmarks for the year. For the income-oriented objective, portfolios are currently providing yields around 3.5%, and that is much more than the yield on US Ag and more than twice the yield on the broad global equity market. So that is our index and portfolio performance. I hope this is exciting for all of us. Now let's take a look at assets and see what assets have contributed to the performance. Firstly, on the fixed income side, for the big picture, US Ag returned less than 1% for the quarter. Treasuries were mostly flat, and long treasuries slightly dipped into negative territory due to the steepened Treasury curve. But long treasuries are still the best performer in 2020 with more than 18% return, benefiting from rate cuts in the first quarter. Treasuries have worked as expected as risk management vehicles in our portfolios throughout 2020. Risky bonds were continuously pushed higher by the positive sentiments in the market during the fourth quarter. High yields and emerging bonds were the best performer in Q4. And we also see US dollar continue to weaken, boosting international treasuries. It posted more than 5% for this quarter. And over the course, we have seen the gradual shift away from the fear of deflation, and inflation expectation rose over the year. TIPS returned more than 10% for the year. This one. And looking at 2020, despite the rocky market, US Ag returned 7.5% for the year, not far below its 8.7% in 2019. And credit, on the other hand, has been on a wild ride. I am sure all of us will have remembered that as COVID shut down economic activities, corporate spreads widened dramatically to the record high in the first quarter, but tightened shortly after the Fed's credit programs launched in March. Credit, therefore, enjoyed a steady rebound throughout the remainder of the year with Fed support. And I'm showing you now the US Treasury curve. Even though the yield curve steepened in Q4 compared to the previous quarter, bond yield remained at historical lows. Yields on the US Treasury 10-year finished 2020 down nearly 1% from 2019. And on the equity side, Q4 was a quarter with of a major reversals. We saw a rotation from toward value from growth and shift from large cap to small cap, and international outpaced US. Small cap value was the best performing asset in Q4 with more than 33% return, bringing its 2020 return into positive territory. The very rebound was mirrored by a revival in dividend as well, and we mentioned this in multi-asset income portfolios earlier. However, this reversal is not enough to change the narrative of 2020. Large tech-related and growth companies still benefited from the new norm of working from home, while smaller companies and value companies lagged behind. Gold was behind for this quarter due to the change in the market sentiment, but was still strong for the quarter. And I would like to quickly mention some highlights for 2020 in terms of equity. This is showing the whole history of VIX. If we look at all the way to the right, 2020 period was highlighted in red. VIX hit record high of 82 in March and remained in the high 20s compared to the historical normal range of 10 to 20. And under this high volatility regime, we have seen the Q4 reversal. We also witnessed the fastest recovery from a bear market in the history in early 2020. But the pace of recovery for different assets are extremely uneven. For example, value and growth. If we look at value and growth, during the course of 2020, the gap between growth and value was record high. And outside US, countries that recovered from COVID quicker have done well for 2020. For example, China has been one of the bright spots with economic activities rebounding close to pre-pandemic levels. It returned more than 28% for 2020. So those are some of highlights of 2020 in terms of performance of our portfolios and assets.